Hello, welcome to Better System Trader Live, the show for systematic and algorithmic traders. Glad you could join us today. Happy to see you here, taking a bit of time out of your busy day. So thank you very much for joining us. And today, we're going to have another fine episode. This time we're talking about, well, the official topic of the show today is we're going to be talking about leveraging market bias. And the guest of today is Lawrence Chan. Welcome, Lawrence. Glad you could join us today.
Happy to be here.
And where are you coming to us from right now? Because I understand it's evening for you. So where are you based?
I'm in Toronto, Canada. So
Yeah.
right now, at my place is 8 p.m.
Okay, excellent. Well, thank you very much for taking some time out of your evening to chat with us. We've got a lot of great stuff to get to today. So I'm really, I've got a whole page of notes here based on our conversation we had a few weeks ago. So I know we've got a lot of good stuff to talk about. So we should get straight into it. But how about first, before we talk about market biases and market context, we get a bit of context on you. Can you share a little bit about your trading background, how you got started in trading and what you do today?
Okay. I started 3 decades ago as a
Wow.
floor trader here. And then since then, I moved on. I manage other people's money. I've worked on both sides of the financial industries, like sell side, buy side, managing funds, and eventually at this point in time, my focus is to build my own proprietary trading firm.
Mm-hmm. Okay. So what about if starting from being a floor trader to where you are now, what types of markets do you like to trade, and any indication about the style or the types of algorithms that really suit you?
Okay, 3 decades ago, the world is more like a gunslinger type of things. Back then, pretty obvious. And then the computer trading things kicks in shortly after I leave the floor, because the internet technology becomes available. So I get to use computers a lot more for trading. And the main markets I trade is it was the S&P 500, the big contracts back then, but it's an open outcry market. And then we all move on to the E-mini S&P. And then for my money management stuff, I trade like forex, currencies, like bond futures, basically anything that actually moves during that time.
Yeah.
So right now my focus. Oh,
sorry.
Yeah.
Yeah,
that's okay. Right now my focus is day trading, all kinds of futures markets.
Yeah. So I guess coming from that kind of background and seeing the evolution of the markets over the last 3 decades, that must have really had an impact on the way that you trade today and the algorithms that you build. Can you give us a bit of an insight into what types of things you look for when you're building your algorithms today?
Well, that has to be contrasted against the algorithm I built for other people in the past. In the past, I think I'm involved in some first generation market making algorithms, and also some like institutions like buy side or sell side algorithms. They've been there for the past 20 years. So if you know something about them, it will tell you that what you should not do as a proprietary trader, what not to try. I'll put it that way.
Yeah.
So the focus at this point for me is something simple, things that actually will give you a very simple edge, and then you will just have to accept the market volatility, and that's the best way to go as far as I'm concerned.
Yeah. Yeah, I remember in our discussion a few weeks ago, maybe it was a month or so ago, you made a comment about, you said that your most important work was how price behaves over the years. So you made a comment about, I think you said 2008, the market behavior has changed since then. Can you explain a little bit more about why you say that and what do you mean? Like, what are you seeing in the markets?
Okay. What happened that is like for majority of the traders we see, they always come and go by around like a 3 to 5 year cycle. Usually like one U.S. election cycle, and then they are gone because of the economic cycle that It also lasts for around like 4 to 5 years. But in reality, we have this much bigger, like an economic boom and bust, where that each of those times you will see completely different behaviors. Like for example, back in the year 2000, the dot-com bubble, that behavior of the retail traders going madly into the market uh, changed the market dynamics back then temporarily for about a year or two, and then it snapped back to normal. Once the bear market hits, everything goes back to normal. And we are seeing the same recurrence back in 2008. And right now,
Hmm.
yep.
Yeah. So I guess if you look at, look back maybe the last year or so, your retail participation has really picked up. We've seen some people say it was a COVID thing. People are at home and they just decided they're going to trade with their checks from the government, or we've got Robinhood and all these other things that are really picking up the retail participation. That's the kind of thing you mean, right?
Yep. Actually, it's nothing new. It's just
Mm.
the same theme recurring with a different with a different like situations. Like for example, back in year 2000 or year 1999, they have the first generation of internet trading for the retail traders, and it is exactly the same. After so many years of retail not participating, we have a whole new generation of younger investors, traders, whatever you want to name them, but they are new to the market, and then they have the latest technologies for them to participate,
Mm.
and there you go. That's what you get, including cryptos. Cryptos is also like another form of market available to them, easier access than the financial markets, because if you go to open a brokerage market, they have certain minimum requirements. So, and you see the wild actions. Anything they touch, they
Yeah.
go real wild.
Yeah. Yeah. So what does this do to the structural bias in the market then?
Okay, the longer term structural bias is always there. It can be a monthly recurring event. It can be like a grand cycle, something that lasts like 9 to 10 years term, or even slightly longer. That will have a theme behind this. Like for example, we right now we're going through a really long low interest rate period, where all the major asset classes go up, and then eventually they will be overpriced. And by certain point in time, you will run out of buyers. So that's a long-term like context. In the beginning of such a cycle, the price behave one way, even including intraday basis. And then in the much later term, like right now, we can call this a very mature like stock market boom cycle. In a mature like time, then they behave differently. And
Mm.
so that is something we need to pay attention to. And then throwing in the mix of the ultra high speed retail decisions at this point, where they will just press the button. 5 seconds later, they see something like feels like it's bad, they will press another button to just get out of it.
Yeah.
And that add a lot to the volatility. And
Yeah.
and for people who has traded for several years and get used to the rhythm from a few years ago, it will drive them crazy. It will make them feel so frustrated, like why it is working this way. But in reality, is that we have to accept it. The fact is, everyone can join the game. So you just like playing poker, you need to know your opponents. That's all.
Yeah. Yeah. So if we look at the application then to systematic and algorithmic trading, you compared, well, you said what we're seeing in the markets now is similar to 2008 and 2000. How can we? Well, first of all, the question is: do you use that knowledge to build or select the types of trading strategies you're using now? Because a common approach, I guess, for algorithmic trading is that you'll test it over lots of different biases, contexts, regimes to see if a
Mhm.
strategy works. But that kind of goes against your insight about there's periods where specific things happen. How do you apply that?
In general, if you develop an algorithm to trade, um, first thing first, it has to be a pretty what I call an atomic strategy. So the strategy, if say it is going to go long, it is going to buy something, then it has to it has to know like when it should not engage. It's not about like you can easily optimize two moving averages and then you can get a profitable strategy anytime. And you will have usually between 40% to 60% winners. It's always that way. You can use any kind of easy strategies. It can be what we call volatility breakout. It can be counter trend strategies. Anything goes because the concept is always the same. The important thing is that you need to know, like for your particular strategy, when will it not working, and then that's the context. Say if it is in a late stage of a bull market, then should you engage as frequently, or certain conditions that you should not trade. And then it is a middle of a bull market. You can buy every single dip. Your winning rate will swing from 60% to 70 or 80%. And you don't need to worry about the condition because the sudden swings against you is not there. It's very simple. Just compare that. And so you can't backtest everything as if it is a homogeneous like data set. It is very simple. Like the major breakout of the S&P 500 since I think 2013, 2014. That big run up is a major breakout. It's a very strong bull market phase. During that, if you backtest anything against that, everything works, including short trades, because it has really, really stable structure, and everything works fine. Long and short side will work fine. So that's what people when they try to create their own strategies have to look out for. If you try to backtest just 5 years of data, I call any 5 years right from the time you now and then the 5 years back. Usually that is the most like toxic period to backtest.
Okay.
It's the worst. It's the worst because it's just one like shorter cycle, 4 to 5 years completed. And if whatever you see right now performing the best, next year you'll be in trouble.
Yeah. So are you suggesting then that the strategies that work today should be actually built on, say, similar conditions, maybe in 2007, 2008?
It can be exactly the same strategy. It can be moving average crossover. It can be any simple things. The most important thing is to add the context in there. Where are you in the market? What kind is it? Is it if you're just day trading, are you in a strong like weekly breakout, say for example, as a condition? If you are, even though you're not trading a weekly breakout, even though you're day trading, you know you're countering that upside breakout is with a counter trend short. It's down. It's context. So if you want your strategy to be stable, then build in context into where you are in the market. If you day trade, then you know at least the daily trend where you stand. Then you will avoid really the late stage of a strong trend to keep going long, right?
Yeah. So then what types of things are you looking for to classify the market context?
It can be very simple. Right. It can be very, very simple. I recall one of the earliest pioneer in algorithmic trading. Steve Nielsen. Nielsen, yeah. I think one of his work is on like 4-day higher lows to define an uptrend. So if today's low is higher than 4 days ago's low, then you are still in an uptrend on daily. Then you should be cautioning yourself that if anything, like you have been having this kind of uptrend for 10 days in a row. So you know your long signal may not be working as well. So you can have exactly the same strategy, but then it knows where it stands in the cycle. Not necessarily a very long-term cycle, even like 1 or 2 week cycle. Then you will avoid a lot of the bad trades. The strategy will become really stable.
Yeah. What about so you mentioned day trading before? What about higher time frame biases? For example, maybe non-farm payroll or
Oh,
Fed
the one we
actions,
talked
that type
about.
of thing? Yeah.
Oh, okay, yeah. And that's the funniest thing about this kind of recurring events. Non-farm payroll happen every month, but it's on a very special Friday. And the rule is so obscure, most people do not know. They cannot program it easily into the charts to see the bias. But if you have done it right, then you will find out that non-farm payroll week has such outrageous bullish bias that if you blindly buy the beginning of the week and then close it right before non-farm payroll is released, which is Friday 8:30 a.m. You have to exit before then. Okay, then we are talking about like outrageous like performance. Every year like 20-30% non-leverage.
Wow.
So it's so simple. They exist, but they are not based on the regular like calendar interval. Oh, it's not every Friday. It is still fixed interval, but they vary. So it's harder to look into. But as a trader, we should always remember that if there's a recurring event, then that is a pattern to explore. The other ones that people used to look at a lot when I was a forward trader is that they always look into the economic reports.
Yeah.
And then they play around the economic reports for some really fast like day trade, because you know the volatility will be there. But nowadays, a lot of those economic reports no longer generates any like buzz. The reason is that like the at this point in time, at this stage in almost all financial markets, the main concern is the interest rate. And so whenever the 10-year like US note, like the yield jump just like a quarter, you will see all the algorithms jump in doing all kinds of ops. So if you are still thinking the old way, so this is a big change from the past. The economic reports, unless it's really, really important, nobody cares about them anymore. The news-driven kind of events has taken hold of the market and create a lot of volatility intraday, because there are a lot of bots built to trade the news, and they train it with AI. I have a friend who did that. Like several years ago, he started feeding news into his AI bots, and then his trading algorithm on the index is completely based on news only, and it works really well. But his trade only lasts something like 30 seconds each. It's still an algorithm, right?
Yeah.
Yeah. So those things they all works, but you need to understand that you can't assume what works today will work tomorrow, especially if you are not leaning on the higher time frame bias.
Yeah. What about you're talking about algos and the impact they have and the behaviors that they exhibit in the market around news time. But what about things that are not necessarily recurring events from, I guess, like a calendar point of view, but but maybe behaviors around certain types of price, or when specific conditions happen?
That's very simple, actually. I wrote a book long time ago. I think more than 10 years ago. Like it's more like a cult following thing now. Because I mass computed like from almost I have a whole database of every single stock trade. I built a library of those data, and then instead of just using those data to try to explore if there's certain behavior, my way of doing it is completely opposite. Like 10, 20 years ago, when I still have access to the university computers, because back then their machine is fastest. So I built boards, like hundreds, thousands of boards, algos, and they are traders. They are tiny traders trading against my virtual exchange, and each of them has a very simple like objective. Say this board is a day trading board, then they try to make a tiny profit. And then there's some other bots have extra information so that they will try to hold on longer to make more money. By creating such a simulation and run it for like many hours, well more than a few thousand hours, something recurring start to happen. And basically it's a proof that price is not random. Random walk is BS, okay? Yeah. As long as the participant has an objective, and every single one has an objective, then you will see patterns. And those price behaviors is well defined. And many older traders, especially from the 60s and before, they all tell you that pay attention to the previous day high, pay attention to the previous day low, look at the breakout of like a 4 week size high. Those are really simple rules. And why they work is that the institutional traders, they don't look at your day trading 5-minute bars. All they care is the previous day close. That's the most important thing. And to them, there are the like 52-week closing price. If you are an institutional investor and that you buy, you are like I'll give you an example, like fund managers I know of, then they all look at the 52-week highest high price of a whole sectors, every single stocks. Whenever those stocks shows up, making a new 52-week highest high closing, that comes into their monitor. And if they find the stock is coming from a really good bottom, and then the stock is healthy, they buy it. Then that means you have institutional money inflow. So knowing what the other participant is doing, and that's why those numbers becomes useful, because the higher time frame players, all they care is their level of numbers. Some people look at weekly only. I know a lot of big fund managers who's managing like billions of dollars. All they care is the quarterly close. That's all they care. Yep. And those highs and lows, all those other things to them, noise. And they utilize the noise to say writing options to improve their use, but they don't pay so much attention to like the daily closing changes.
Yeah.
Yeah.
So I guess an extension of this, you said knowing what the participants are doing. You made a comment earlier about algos and their behaviors were very predictable in some situations. Why do you think it's that is the case? Why are these behaviors becoming predictable now? Is that like an indication of the tools,
this
or
is
what is that?
part. Because I have a lot of friends working for like quad funds, and some working for themselves now. After they make enough money, then they go on their own. They are all like hardcore science people. So basically physicists, like math PhDs. Some of actually a few of them are chemists too. But the tools they use is all the same. They always use statistical method. They always use the same like kind of analytical tools they used to use when they were doing academic things. And they are happy with massive amount of data. The more the better. Tech data, they're very happy to play with. So they all come up with the same answers.
Yeah.
More or less the same. Because they have certain criteria. If you're working for a firm, and then your firm has certain like risk level, risk tolerance, then you will be like, and every single firm has a very similar risk tolerance level. Then you guess what? They all have to come up with very similar algorithms because they have to explore the same edge or same bias in order to stay within the risk parameters. So at the end, every single board they deployed it into the same market. More than 50% of them is all the same. And
yeah. Do you think
and when they all move together.
Yeah, sorry, go on.
Yeah.
I was just going to say, do you think that is what leads to that particular edge degrading over time, because more and more people are piling into the same kinds of trades,
Yeah.
they're using the same data, the same tools, the same analysis?
Yeah.
Yep.
At this point in time, if you are thinking of like day trading the like sub-minute level down to the second level, I can tell you that majority of those new edge people find, they don't last more than 3 weeks. Every firm is rushing to the next one that is really promising. And then when you don't need 100 big firm going in. You just need 2 big firms going in head to head. They will destroy the edge.
Yeah.
Because they will soak up all the liquidity themselves in such a small time.
Yeah. Yep.
So as a day trader or as a proprietary trader, don't fight them. Don't go for the sub-minute thing. You can't beat those guys.
Yeah. Yeah. So I know on your website, daytradingbias.com, you've published some studies up there from years ago, I think, that
Yep.
those edges still work today, even though you published them quite a while ago. Why do you think that is?
I'm actually like back then the majority of the articles and the code I wrote is free. People can still access them for free. You just sign up as a free member. Just read all of them. And the hard part is if you are a beginner in trading, or if you want to go for like algorithmic trading, we usually think in terms of whatever the platform is offering us, right? So if you go on to something like I won't name the platforms, say they give you a whole bunch of indicators. When you're learning the platform, you will play with whatever they gave you, and that's the first impression. Yeah. The first impression is like it may be certain moving averages. They provide you with 20 different like pre-built strategies, and then you try to optimize them. You see them profitable, then it gets you high. Yeah. But that's the problem. That's the wrong path to go down. Yes. And the right way is that you have an understanding of what you're going after. You need a plan. My mentors who get me into like a better trading like style when I first get started is you need a plan. what you want to make from the market, what kind of personality you have. That's very important too. It's a trading psychology part. We probably don't have time to go into that part, but it's very important. If you can't stand a strategy's heat, you're not comfortable seeing it operating, even though if you are like trading it automatically, you will shut it off at the worst time.
Yeah.
So that's very important. Something simple is not to most people's taste. Going back to what we just talking about, why people are not taking advantage of those strategies. Because I was thinking like it's more like an experiment. I don't mind giving out all those things, and if you like, you incorporate it into your own strategy, then it will improve your trading. It turns out the majority of the people is either asking that not really asking, they're commenting nicely that if it's so good, why would you give it out?
It's a common comment. Yep.
That's fine, and then after years, every few years, I will try to update the performance of those strategies, and they keep holding up year after year after year. That's why it's fun.
Yeah. So do you think, extending from that comment you made about platforms giving you all these indicators and you can do all this fancy, complicated stuff, do you think that by reducing your tool set down to a small number of simple things, does that hurt the complexity of the strategy then, or is that like not the right way to be looking at it?
Starting with something simple is important, as opposed to focusing on something like really exotic. As I said, 2 moving averages is fine. Very, very basic breakout system works fine. And then build from there. You need one working strategy, long side, short side, to be balanced on the market. And after you see it working, and after you trade it and you see the profit, then you will realize it is easier than you think. But as long as you haven't go through this very basic exercise, you will keep looking for the highest winning rate. You'll keep looking for the most exotic way, so that you will have like minimize the drawdown, but they only works in the back test. Because you optimize it against the historical data. And it is one of those misunderstanding about the backtesting thing. It's a tool for you to understand a concept, but then once you start trading it in real time, you're looking into something that has not happened yet.
Yeah.
And then the randomness of the data, certain kind of if you are trading 5-minute data, and then your 5-minute makes no sense to you for 3-4 months. The reason is the market could be going into a tight range, and the tight range means in the past is summer. Every summer in the past, when I was trading offshore, the indexes there are 5-10 years, every summer we can just walk away. There's nothing to do. But if you throw in a 5-minute automatic strategy there, the market, sideways market, will eat it alive. So you need to know when not to touch the market. So again, it's going back to the context. The higher time frame is going to congestion, and you know it is, then your strategy should be automatically turned off.
Yeah. In our discussion a few weeks ago, you made a comment, a quote, actually. Let me just read it here from my notes. You'll never know why a strategy is not working if you never look at a chart. So I guess for algorithmic traders, typically they don't bother looking at charts. It's all about the numbers, right? Do you think that's is that a mistake that algorithmic traders are making by not looking at this additional data?
Well, this is one of the problem, because I came from discretionary trading. Floor trader does not look at chart much. Afterwards, then I trade for a long period of time with simple charts, because I have good mentors teaching me how to read the chart properly. My chart does not have all these fancy lines and things like that. It's the most basic classic style. And what I learned from that, and then also combine that with the simulation research I told you just moments ago, it turns out chart pattern is the result of those human behaviors, and they recur for that very reason. So chart essentially tells you where the market is going. You don't even need to be a very good chart reader. You just need to look at it with the context in mind. So for a lot of algo traders trying to design their strategies with numbers only, once they open their mind, say for example, paying attention to the previous 1-2 days high and low, or say for example, is previous day an inside day, a very, very simple concept. An inside day gives you a meaning. It tells you the indecision. And then for chart traders who see inside days, then they know they're looking for breakout. And then why can't an algo trader do the same, utilizing the pattern? And it's simple enough, and it can be easily backtest. And I can tell you that it works really well, but not on the indexes. It works very well in currencies. It works very well in energies. Simple stuff. And it becomes one algorithm you have.
Yeah.
Okay.
Well said. We've got a couple of comments and questions in the chat, so maybe we'll address a couple of these. So this one is from Jeff. Thanks for the question, Jeff. Lawrence, what do you consider to be the biggest bias edge in futures trading?
Okay, we look at it as two questions. How about that?
Sure. Sounds
good.
Let's
address the edge part. For people who engage in futures trading, you're using leverage. So if you're using leverage, the number one thing is control your risk. Your leverage has to be controlled to the point that you will survive. That's the real edge. I know some people, but it is like it's abnormal. He's a really well off person. From his he sold all his businesses and he went into like futures trading. He does not use leverage. He does not. The only thing he likes to trade is gold future. I learned a lot from this guy. But then I asked him how much he put up for one contract. He put up the full amount. And he does not feel any pain, anything from his trade, because his expectations using future to trade the upside, because buying physical gold is not liquid enough. So he's doing really, really well over the past 10 years. Wow. He basically buy every dip. That's all he does. Okay, so if you're trading futures, then that is the first thing to consider, is limit the leverage you use as much as possible. Then you will survive, and eventually you will see the light when your trading style or strategies becomes like consistent. And then for the biggest buyers, and then that depends on what kind of trading you want to engage in. The easiest one to lean on is always a volatility breakout. It's always been, it always will be. Because technically, when compression happens, when it compresses enough in price, so that means think about the human psychology, and even bots have psychology, because somebody owns that account. So when enough traders are trapped inside that compression, it will explode, not by choice, by stop out. So when you enter the volatility breakout, you're taking advantage of those traders who's on the wrong side. Think of it this way, then you will see why.
Yep. All right, thanks, Lawrence, and thanks for the question, Jeff. There's a comment here from Charles, not necessarily a question, but maybe you can add a little bit to this one, Lawrence. Let me just put this one up on the screen. I think this one dropped into the chat just as you started talking a little bit about the psychology of trading, but we glanced past it. And this comment from Charles, it's usually a bad sign when I have no motivation to work on a strategy. Do you have any comments for that?
What happened is, majority of retail traders who try their hands on automated trading, try to design their own strategies, usually suffer one big issue. The big issue is that they try to test everything out because they have no idea like why price is moving certain ways. And then it's the lack of understanding of what we call the microstructure. Price movement has certain microstructure exists in them. There are good books out there talking about this stuff. But in general, what microstructure, why it exists is that you are not the only person trading the market. There are market makers that they try to just make money through the order flow. There are market makers who specialize in options, derivatives on whatever you trade. They need to opt. So when there's excessive like option like activities on the underlying, then the market makers need to hedge, and they will move the market while they're doing that. So what it means is that by knowing the microstructure, knowing what these other players are doing, then it will give you an idea like why an idea actually works. For example, why one of the most famous strategy around, everybody talks about it over the years on index, is that its gaps usually get filled. But why? It's not the index gap got filled. It's the underlying stocks, like S&P 500 and 500 stocks. On average, every day, there's 80% of the stocks that gap up or down, the gaps got filled for all the components. I have all the stats myself. The reason is the market maker who makes the market for the stocks, they gap it because there are too many people buying, so there's a gap up. Too many people selling at the open or the opening order, then it's gap down. But they will make it to their advantage. It gaps so far away, then they can cover later on. And so the dynamics is there. That's a reason why the gap got filled.
Yeah, the other day when we were chatting, you mentioned something about don't think. Let me see if I can get this right. Don't think in terms of numbers. Think in terms of concepts. Is that what you're trying to say here?
Yep.
Right. Okay. And so I think for an algorithmic trader, not to think in terms of numbers sounds a little bit counterintuitive, right? Because it's all about the numbers. Well, not all of it, but it's
Yeah.
very numbers driven. How do you balance the two then?
The concept will be the core driving force of a strategy. Because you're asking the question at the right time, because I just finished training up like some people working for me to do the algorithm like refining and stuff. So every strategy has a core, a theme. Like if it's breakout, then say focus on that one side, breakout upside. The other kind is continuation trade. So that means you are going against a shorter time frames pullback into certain kind of mean, and then your expectation is actually that it will follow through in the original direction. So the two kinds of trades have different engagements. So the concept is right there. So you will separate the two. First thing first, when you write them, don't put them all into the same strategies. It's a big mistake. A lot of people like to put everything neatly into one box. But in reality, you have to separate them so that you can test them purely, and you will know exactly what they do. So, like for example, the pullback situation, then you will collect the statistics. That specifically, like what do you mean by pullback? That's where the number comes in. What is an acceptable pullback? Is it like how many percentage, or is it a percentage of the range it goes through, or do you use moving average as the mean, or a lot of the day trading algorithm nowadays, including institutions, they all use VWAP, and it is basically a concept translated into something more concrete. The concrete part does not have to be exact. You can use like certain moving average works, and you don't have to refine it. If 20 period works, you don't have to go to the details. Like I prefer the 22.
Yeah,
it's not needed. It's something simple as long as it carry your idea. And then if it is a good strategy, it will carry. It will do fine. It will do fine in the raw form. And then the refinement comes in, like how you put the context in there to avoid trading when the strategy is not suitable for that time.
Yep.
Yeah.
Thanks for clarifying that one, Lawrence. We've got a couple more questions here in the chat, and then we'll start wrapping up for today. So we got another question here from Jeff. Do you trade through all events such as news events and events like the COVID crash?
Okay. Yeah. I will have to separate that into two parts. Okay. Yeah. Because aside from my algorithms, and also like I now build a team of people working for me we're partners working creating more algorithm for different markets. But then I personally still like have a high risk account that I trade. Okay. And as a day trader, but for so many years, it's really hard not to engage. And yes, I did trade through many of those events. And then one of the favorite I like to trade is actually the FOMC meetings, like announcement. Yep. The worst time for most strategy to engage. But then as a discretionary trader, and I know the key price levels of what to look out for, then you can take advantage of that. And you can take advantage of against the boards. It's not about me like good at like countering or following the trend or anything. In an event, the most important thing is to identify the boards. If they all jump on the same side, then they can't escape. And then they will either they will force the market to keep going, or they will be fated, and immediately you see them got crushed. Yeah. Either way, you can get a piece of the action. You don't have to get the whole thing. You can get a piece of the action.
Yeah. All right, thank you, Lawrence. Here's a question from Ola. G'day, Ola. How do you come up with strategy ideas? Do you start with an edge first or momentum, for example, momentum, and then try different ways to exploit that? Or do you test different patterns, for example, to explore their potential?
Well, it all comes back to the fundamental concept of how a chart works. Basically, in classic chart reading, we talk about the most basic form in my another old book. I think this one come from around 10 years ago. Yeah, is a chart is about expansion and compression. Before we look at all these fancy like lines, patterns, from the compression, when it start to expand, does it develop into a wave of like going higher and higher and so on? Then you have an uptrend, right? So this is classic concepts. It's very important to remember the classic concepts. So there are only limited number of ways to engage. You either hop on to the expansion, you can hop on by the breakout, you can hop on by the pullback, and then after you ride a trend up, and then after the trend has matured, after 3, 4, 5 waves, then a trend will be matured, and then at that point in time, it's no longer favorable to keep buying the dips. Then you will look for counter trend. So all these is already written in the chart pattern itself. Basically, you have only like around, in general, like trend or not trend, counter trend, or playing like following the trend. Then you have 4 combinations, and then you can choose to engage with like fading the move or doing the breakout moves. Then you introduce another like boundary variable. So you have 8 combinations. Then you already have 8 kind of strategies to backtest. So there's no guessing. It's basically a chart, a structure. It's already exists. So what you do is that you pick which piece of it you want to tackle, and then you will have a strategy. And they all work in synergies. At the end, you will have the long piece going really happily going along the uptrend, and then your counter trend will become when you go counter trend short, your long strategy should be staying out of it.
Yep.
Okay.
Thanks. Yeah. Thanks, Lawrence. So you mentioned a couple of books and in our chat today, and I've got a question here from Phil. Let me put this one up on the screen regarding books. Not sure if you covered this already. What books does Lawrence recommend aspiring algo traders should read?
If you just start out, the most important things to read probably is not from trading. It is very good to start learning something about like human psyche. Yeah, because what happened is, what I find out is majority of the people, they have preconceptions of how the market works. And so if you go out and read those books that actually give you really good idea, helping you how to do trading, you will not like them. It will make you like feel uncomfortable. Even though you learn something from the book, you will not do it. Okay, and that's the fundamental reason why people can't get their first strategy working. Basically, ever. The problem is that they haven't taken care of their own internal problems. Because like successful day trading or successful algo trading is a rare thing for a lot of people. Not as rare as discretionary trading though, because you can offload part of the mental pressure to the machine and blame the machine. But then it is still you. If you're going to trade a strategy, you got to be comfortable with it. So your psychology has to change. You have to change as a person first, so that you will be open to things that you don't believe in. Because there's a lot of things that's so simple in trading that people refuse to do. One of the very functional strategy, I can just say it out loud. Almost for all the the precious metal markets or energy markets late in the day. If you see it go up for the whole day, and at the old times when the online trading like first come to the world like 15-20 years ago, one of the traders I know of say it best: when the chart go up above the screen, we buy, because the monitor cannot catch up. It still works, but most humans don't do it. The last hour of trading, when it's still going up, you just go in and buy, and usually you will win big from those trades, and your losses is all contained. But will you do it? Until your psychology can accept that, it's really hard.
Yeah. All right, Lawrence, one more question, then we'll start wrapping up for today. This one is from Ola. Do you find market internals useful to define the context of a strategy?
Depends on the type of market internals you're using. Sometimes they will give you conflicting signals. Sometimes they will confirm it. It all depends on the internals you're using. Well, because I pioneer certain kind of customized market internals, like market graph, data, real-time data thing, some 20 years ago, and if you search for my name and tech index, you probably can find some of those things still available online. So by having a customized like a market graph, for example, advanced decline, but instead of using the general one, use the one say S&P 500 or the Nasdaq 100. Those ones will give you more precise representation of the index you're trading. The general market one right now is too noisy to be of use, really. But then there are other market internals that are very useful. Simply put, like volume. Those things, just in the volume of the index you're trading is already a very good indicator. When volume is too low, everything fails. Yeah. And right now, every 10 trading days, you still have 1 or 2 of those days. Yeah. So just be aware of those, and your strategy should just shut off.
Yeah. All right. Well, thank you very much for your time today, Lawrence. We're almost out of time here, so we'll start wrapping up. So if people wanted to learn more from you or get in touch with you, what's the best way for them to do that?
They can go to the Day Trading Buyers website, or they can find me. Either there's a form there. I forgot. Like I have a Twitter account, the Lawrence Chan. So, but you can find my email address there, and my email address, or maybe we can just say it here. It's Lawrence@daytradingbuyers.com. So anyone who wants to contact me, just feel free to do so. Yeah.
Yep. All right. Well, thanks a lot for your time today, Lawrence. I really enjoyed our chat. We're getting some great feedback in the chat as well. So yeah, we had some excellent questions. So thanks for everyone who participated today. And yeah, thanks again, Lawrence, for taking some time out of your evening to chat with us. And
my pleasure to be here.
Yeah, it's always good to talk to fellow traders. So yeah, thanks again. And for anyone who's joining us today, please remember to hit the like button or the thumbs up button on the video, just so we can spread the word for what Lawrence has shared today. So we've got some good feedback coming in. Let me just put a couple up on the screen just to finish off on a even higher note. Adam said thank you. We've got Ola, thanks Lawrence for a great session. And Phil said, great session. Thanks a lot. So thanks again, Lawrence. Thanks, everyone, for joining us today. And I wish you all the best.
Okay.
Take care.
Bye.
Cheers. Bye.